The 2021 automobile loan default and car repossession crisis. How bad is it going to be? We're going to take a look here and hear out of some industry insiders, some experts, and what they have to say, and it's not good. You might want to fasten your seatbelts. Let's get into the information here. Car and Driver article, caranddriver.com, auto repossessions likely to rise in 2021 as the pandemic goes on. With no new federal aid on the horizon and the pandemic ongoing, experts think that many more vehicles could be repoed. If that's you, start talking to your lender now. Now, isn't it interesting that just about every article that tries to forecast what's coming in 2021, they always have to point to federal aid. Federal aid. Everybody's dependent on federal aid. All right, when's the next stimulus check? When's the next enhanced unemployment benefit? Just give us UBI. Gimme. People need handouts. And we'll get more into the flawed system here towards the end of this video, but let's take a look at some more details out of this article. With the businesses and schools shut down, alongside the increase in cases, more people will lose their jobs or will in some way suffer economic hardship, and that will mean missed debt payments, which translates to a surge in auto loan repossessions. And that prediction is out of John Van Alst. He is from the National Consumer Law Center, and he says, quote, "We've certainly seen an uptick in defaults and delinquencies. I think that's going to translate into a really large increase in repossessions." Well, he's not the only one saying that. The American Recovery Association's Les McCook echoed that point. He said, quote, "I'm almost certain the number of repossessions are going to increase. I've been in this business for 50 years. And there's never been a time like this," unquote. Now, we don't need to rely completely on forecasts and guesswork. It's happening now. Auto defaults climb for the 4th straight month, and this is out of automarketing.com. And you look up here, you see the word subprime. Well, subprime loans have been surging in the past few years as more and more consumers were getting tapped out. Remember, they had to loosen the guidelines for the lending. Continually lower and lower interest rates, as all of you probably know by now. The looser lending, the extension of the loans, more 6- and 7-year car loans, more people borrowing in other areas to pay for a car or sometimes just to get a down payment, home equity loans being used to buy cars or at least down payment on cars. And going back a couple years, we've been documenting this trend in the rise of subprime auto loans. And you can see this article from a year or two ago here out of Forbes, right? But this economic boom, including the boom in automobile sales, which really wasn't a boom, they've been holding steady. But the reason it hasn't dropped or fallen off of a cliff is because of debt. It all goes back to the debt in the monetary system. And a recent report here out of Calculated Risk, New York Fed third quarter report, total household debt increased in the third quarter, led by a surge in new credit extensions. The Fed Bank of New York's data today issued a quarterly report on household debt and credit, which shows total household debt increased by $87 billion to $14.35 trillion as of the third quarter 2020. This increase more than offsets the decline seen in the second quarter of 2020 as total household debt surpassed its 2020 first quarter reading. So we're at new all-time highs in debt. And here's a chart here via the New York Fed, and I drew a couple lines here where we were at the peak of the financial crisis and where we're at now. And we see we're much, much higher than we were total, including auto loan debt. We look at the green right here. Here's where we were, financial crisis peak, before the big bubble went pop there. Let me draw that one again here. And where we're at now, we're in a much worse situation now. Much more debt, more people leveraged. Banks are more leveraged. Banks have been unleashed to lend to more people now versus the financial crisis and leading up to the financial crisis. And when I ask people for their opinion on how this ends, I usually get a very diverse set of projections, or very diverse projections. Some people say modern monetary theory, JJ, it's going to keep going. They're going to continuously inflate the bubble. It's not going to stop. all the way to hyperinflation. They're going to hand out so much money, they're going to completely destroy the currency. And I hear you, it's definitely possible. And the current modern monetary theory, it's actually not a theory, but that's what it's called. Unlimited currency created out of nothing can be created in infinite amounts at the click of a mouse button. And yes, they can create or keep the bubble inflated. And even when the consumer gets completely tapped out, some people think that'll be the end of the line. Not so fast. They can bring in UBI and a continuous stimulus. Imagine the $1,200 stimulus check that was handed out earlier in 2020. Imagine that every month. What if they bump it up to $2,000? What if they bump it up to $5,000? You're going to see prices for goods and autos and even services rise so fast, it's going to make your head spin. It's going to be absolutely insane if they do this. But if they let it deflate, if they pull the rug out, if they say no more stimulus, no more bank support, which I don't think will ever happen, but if they did that, it would be absolutely a wipeout. Also, it would make your head spin, but in the opposite direction. All right, speaking of comments, let's take a look at one right here, one recent one out of Money Making Bear. Government using modern monetary theory as they do for everything else to pay all back rent for everyone. Wow, free rent, that sounds good. And give everyone the 2,000 UBI that was supposed to be retroactively in 3 months past the end of the pandemic, along with the Green New Deal. Remember the Green New Deal, a hiring program that could create a lot of jobs. All right, it's possible they could do that. And is it going to fix the problem? Well, no, not necessarily. It's just going to cause more rising prices. If you can get people to produce things and manufacture things, then that's what the economy should be based off of. It should be based on production. All right, so folks, there's no easy way out of this. Let me know what you think. Do you agree with Money Making Bear? Should it be modern monetary theory, inflate to infinity, create all these programs which will create jobs? So everything's going to be fixed by more government? Or is it just the opposite? Do we need less government? Do we need less market intervention? Do we need to allow the markets to function, allow deflation, allow prices to correct, and try to get back to somewhat of a market based on actual supply and demand instead of all this rigging, intervention, and manipulation? You let me know. I think you know what I think. I think they should just let it all correct. It'll be painful, but we can get back to a real economy. But before we can do that, we need to get back to sound money. Please like, subscribe, let me know what you think. Stay well, stay safe, stay prepared. Bye, everybody.